Where do you find quality growth right now headed into Q2?
Well, thank you, Alex, for having me. I think the thing that's important right now is that there still is, despite the fact there's been some calm in the last few days, there's probably a lot more volatility in the markets to come. We don't really have much in terms of data from companies for the first quarter yet. There's going to be a lot of unknowns that are still yet to be determined. And I think from that perspective, when we think about investing in companies, you hopefully have already built in a foundation of quality into these portfolios. Trying to make those kinds of changes right now is frankly pretty difficult, but you're looking for businesses that have durable competitive advantages, certainly a lot of free cash flow that they can produce without having to go to the markets to raise cash. And you end up in businesses that hopefully have more of an inelastic demand characteristic to their business, so that they are actually in good shape regardless of the volatility that's taking place. Companies in healthcare, technology, consumer staples, certainly there are very good businesses that are continuing to produce and thrive even within some of these more challenging times that we're facing.
Can you give me some of your top picks?
Well, certainly a couple of names that we've got towards the top of our portfolio have been benefiting, or at least being able to be good stewards in this environment. You think about a Becton Dickinson, which is in more of the diagnostic tests and needles and syringes parts of healthcare. They recently came out with a collaboration to hopefully be able to produce more COVID-19 tests, run them through their own diagnostic platforms. We think this is a long-term business that will certainly be fine regardless of how this all unfolds, and continue to thrive. Another really good name, obviously, in the workspace as we all now move to this remote from home environment, is Microsoft. We just saw some information even yesterday that showed that their cloud usage is up nearly 800%, and that the number of users they've got working through Microsoft Teams somewhere in the north of 40 million users now. These are businesses that, frankly, are in position to do well when things like this happen. Those positions haven't really changed. They're the same kinds of positions they would have had prior to this pandemic, but that inelasticity of their company profile allows them to, frankly, do pretty well regardless of what's happening. And we think those are the kinds of companies that, we've had those positions for a while. Now they can do what they do best, which is continue to produce cash flow and high returns.
Well, I'm glad you brought that up, because my question was, did you buy anything new after the virus broke out, or these just happened to be picks you already had that then also wind up benefit because you're looking at sort of a long-term quality growth story? And if you are adding new positions, where would you be doing that now?
Well, we have not. We've added a couple of names, but nothing that I would say is substantially different from the way the portfolio has been built before. What we've been trying to focus on is, trying to be tactical in a market that has had the kind of volatility, the fastest bear market in history, frankly, one of the fastest returns to a bull just last week. When you have that sort of environment, it's pretty difficult to try to make too many tactical changes when you think about investing from a long-term perspective, which is what we ultimately do. Our profile is that we want to build returns that can do well in up markets, but then also hopefully protect investors better in down markets. We've seen some of that. We've seen some confidence from some of our own clients where they've been giving us more capital to try to deploy. And we continue to emphasize those same ideas. The competitive advantages are going to matter. More businesses are probably going to struggle for the foreseeable future. We don't know when this recovery is actually going to take place as far as rebooting the economy. It could take some time. There's going to be some more ups and downs. So if you emphasize companies that have these characteristics of quality and competitive advantage and cash flow, you have less likelihood of going through some of those roller coaster days that we've all been experiencing over the last couple of weeks.
So when you head into earnings season, what kind of visibility do you expect to get? I mean, you've had downward revisions for the first quarter really sitting at a record. Second quarter's coming down. Third quarter starting to come down now, too. How are you going to be judging the earnings?
Well, I think the key here is to make sure that we see some level of potential transparency from businesses. As you mentioned, a lot of earnings guidance is coming down. Some of it's frankly just being pulled entirely. And that's obviously reflective of the fact that these companies, most of them don't really have a good sense of how long this is going to take place. It could be a quarter, it could be a quarter or two, it could be, more into the fourth quarter, maybe even into 2021. We just don't know exactly how this will ultimately turn out. And so what we're going to be looking for trends to see what's happened in Asia. As Asia has started to reboot, that may give some signal as to how things might translate elsewhere. But it's really going to be in the commentary that the companies provide, because the data is probably not going to give us too much in these early days as we move into the first quarter earnings season. It's